jump on.
Cool. And again, at any point,
No, I'm not sure.
feel free to raise your hand, ask any questions you want, that kind of thing as well. I'm just going to mute you guys for now and just unmute yourself if you have any questions, okay? So without further ado, let's get started. So when we're talking about today is going to be the stock indexes, specifically the stock indexes that we can use to both passively generate wealth over time and the indexes that we can use as indicators of the market and the economy, right? As we know, the market and the economy move separately. Wall Street and Main Street are very different. And we have to be able to differentiate what is happening on Wall Street and what is happening on Main Street in order to make, investment decisions that are based on logic and statistics, right? So we never want to be considered gamblers in this situation, right? The stock market is about creating wealth over time. So we're going to be talking about how to use the indices as both a wealth gainer, a wealth protector, but also, and I give you an idea of how you can move along with your investment journey without just being a sheep being led along by Wall Street, right? With that being said, I am not a financial advisor, accountant, or fiduciary. This is all supposed to be for educational purposes only. So any of the information that you hear, that you see, feel free to verify it yourself through your own research, through your own analysis, and make sure that you do your own research and analysis, because this may sound like financial advice, this may look like financial advice, but I promise you it is not, all right? I'm just trying to give you guys some information and education that'll help you make your own decisions based off your own research, okay? So understand your own risk tolerance and go from there. Before we jump into the indices, 3 questions we want to ask ourselves before we start investing in any stock or ETF, and honestly, any asset class, right? We want to ask ourselves, does this company work within my circle of competence? Otherwise known as, do I know how this company makes money? Do I know how this company builds their product? Do I know who this company's ideal customer looks like? Do I understand how they can acquire customers? Is this something that is something that is sustainable, right? Like, can I really understand how the company is going to build my generational wealth, but also protect it over time? And then ultimately, have I done the research necessary to make informed decisions about the stock and or the ETF, right? We all know that stock prices go up, they go down, depending on what happens, right? We know fear, greed, market sentiment drives prices. But what we have to understand is that our research is going to be the driving factor in whether or not we stay or sell within a stock or ETF, right? How sound is our research? That's going to really tell us how sound our investment is going to be. So with all of these presentations and sessions, I really like to talk about quotes that give an idea of where we're coming from, right? So this quote, success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing. So what does this mean, right? This is a quote from Warren Buffett, probably the most well-known investor of our time. What is this quote supposed to do for you in terms of giving you an idea of your investment mindset, right? We know that the market is not driven by anything but emotion, right? So who's buying, who's selling depends on who is greedy, who is fearful. So what you want to do is take the emotion out of investing. And how do you take the emotion out of investing? You give yourself time. You allow time to build your wealth and mitigate your risk, right? We'll talk a little bit more about that as well, but look at this quote and really take it as something that you internalize to help you build your mindset. So what is an index? In financial terms, what are we talking about when we are talking about indexes? We're looking at financial data that is being used as essentially a benchmark that we can take some more data and track it against, right? All the indexes really is a way for you to really understand on a macro level how things are moving together, right? So we can use indexes as small scale evaluators, financial trackers, but also as ways to build wealth, right? So we mentioned before, the market moves on sentiment, right? Fear, greed, emotion. The market also moves according to the economy. So we talked about Wall Street. Now we're talking about Main Street. When Main Street goes through things, the market looks at it and decides what it's going to do, right? So we started with using it as a benchmark, as an evaluation. Now we're using it to really see where the economy is within context of the market itself, right? So we've looked at the market by itself. Now we're looking at the economy in context with the market, right? Because you can't have the market without the economy, vice versa, right? And then historically, it's traditionally the best way to park your money if you're trying to build wealth passively. If you're just trying to set it and forget it, there's indexes that you can just put your money into, and ideally, you never look at it again. You get your 5, 6, 7% return over time, right? So those are three different ways we can look at indexes and really understand where we can use them in our investment journey, in what ways we can use them as, right? So let's dive a little deeper into some specific indexes. So first, we're going to talk about the big four. The big four, in terms of like how I see it, right? So we have four big indices that we kind of know and love, that are publicly known. More often than not, you're watching CNBC, and these are the tickers that are going across your screen at the time, right? So when we're talking about the big four, we're talking about the S&P 500, the NYSE Composite, Dow Jones Industrial, and then the Nasdaq Composite, right? The S&P 500 is Standard & Poor's 500, index of 500 largest companies in the United States. We'll dive into that a little bit more in terms of what that means. The NYSE Composite is not an index that you'll probably invest too much into, but it's something that you want to pay attention to because it pretty much covers all of the stocks listed on the New York Stock Exchange, right? The Dow Jones Industrial, we're looking at that index mainly for those blue chip companies that have been around forever and that they have those flawless balance sheets that we can really look to exploit in economic downturns, right? And then the Nasdaq Composite, it's an exchange that's listed on the Nasdaq Stock Exchange, right? So we're going to dive into these each a little on their own, but we're going to really think about them in terms of the big four. So on the macro level, right? Again, Wall Street, Main Street. When it comes to Main Street, we see these big four, indexes, and when we see them go up and down, oftentimes we're like, "Wow, the stock market is going up. Stock market is going down. Wow, things are going well. Things are going not so well." But in terms of the stock market itself, Wall Street, the big four are only being used as indicators, right? They're only being used as benchmarks. So when we're talking about the big four, we really want to be able to look at it from both ends of the spectrum. We want to look at it from a common person who's not invested, but also as a retail and institutional investor who might be trying to use the indexes to make money. So these are the three major indexes overlaid on top of each other. The New York Stock Exchange Composite isn't on here, only purely because it's not one that you'll be invested in too much as a beginning investor or a retail investor, right? So if we just look at the last 20 years or so, right, on the rates of return between the Dow Jones, the Nasdaq Composite, and the S&P 500. So the Nasdaq is in purple, the Dow Jones is in red, and then the blue is the S&P 500. If we can look at that across the last 20 years, what are some conclusions we can draw from the picture? Go ahead and type in the chat what are some things that we can kind of see from the chart in front of us. What are some things that we can kind of see? And no wrong answers. Just type in chat. What do you think? Any takers? Come on, y'all. Participation. What are some conclusions we can draw from this this chart? Unless we're talking, let's go on mute, please.
Oh, can you hear me?
Yeah.
All right, cool.
Are you gonna participate, or you just say hi?
Oh, I'm just trying to catch up real quick, so I'm gonna just hang back.
Cool. All right, y'all. So I know we're shy. It's okay. I'll let you slide on this one. But what are some conclusions we can draw from this picture? Right? Real basic. Look at the rates of return all the way to the right, right? Look at that percentage for all of these indices. Almost 500% for the Nasdaq, almost 300% for the Dow Jones, and then almost another 250% for the S&P 500 over the last 20 years. So just based off those numbers, right? If we just think about the average bank account return on your savings account, right? Your 0.0 whatever interest rate, it's not 499%, right? So even in 2000, at the height of the dot-com bubble, when we were up almost 150%, and then we dropped down after the dot-com bubble, and we lost pretty much all our gains and more. Even if you had lost all your money in the dot-com bubble and you had just reinvested and held, you'd be up another 500%, right? So just to give you an idea of how the markets don't necessarily coincide always with the economy, but when downturns do happen, we want to be in a position to take advantage, right? So just giving you an idea of what these markets can do for you over a 20-year period, obviously take it for what it is. This is not a indicator of what future returns are going to be, but just these three indices alone are giving you more rate of return than your average investment vehicle, right? So let's dive into Standard & Poor's S&P 500, right? So we got to understand that the Standard & Poor's company is not just the S&P 500. It's one of the products of the Standard & Poor's portfolio, but the overall company is known as a credit risk researcher, right? So they essentially are giving credit ratings to public, private, and government entities and rating them on their risk level in terms of debt management. So it's important to understand that the index itself is just a benchmark for those large weighted those large weighted companies in the U.S. market. However, what it's coming from, what it's being built off of, is it's credit, right? It's being built off of companies that are trustworthy, companies that are spread across multiple asset classes, and then companies that have products or revenue that is stemming from places outside the U.S., right? So if we look a little deeper than, oh, it's just the S&P 500, it's 500 large companies. These companies are there for a reason, right? We have to understand that they're there for a specific criteria, and that they're not just being picked out of a lot, right? There's a whole bunch of large companies in the U.S., and a lot of these S&P 500 companies are not the largest companies in the U.S., but because of the criteria that they meet, for example, 4 straight quarters of profitability. They've been around longer than a year. Their revenues have grown over a certain percentage over time. So there's certain criteria that you need to be in the S&P. But before all that, the S&P has to look at you as an entity that can be trusted, right? That can be trusted to give back to its shareholders over time. So when it comes to the S&P 500 index itself, the index is made up differently than a lot of the other indexes, and we'll explore those also. But this is a float adjusted market cap, right? So for the S&P 500, how they squeeze these companies in and how they kind of measure who gets more of the index than the others, right? Because obviously Apple is going to be bigger than in like a Caterpillar. in the S&P 500, right? Because of just how many outstanding shares they have, right? They're going to be bigger and more included in the S&P 500 because they have more float adjusted shares. So those float adjusted shares are all the shares that are available to you and I, right? All the shares that I can buy, all the shares that you can buy. So not the shares that are locked up in the institution, not the shares that are locked up with the CEO and the rest of the board, right? We're talking about the shares that are available for you and I to use. So based on those total amount of shares, the S&P is going to bring you into the index in terms of what the other companies bring in too, right? So just because you have 3 billion shares outstanding doesn't mean all 3 billion shares outstanding will be taken into the index. Does that make sense? Right? Because you have to adjust it for the other companies that are in there. So we'll keep diving into that and pop in it with any questions if you have them. How are you investing in the S&P 500? There are multiple ETFs that track these indices, right? So this S&P 500 gives you 500 companies, right, that are some of the largest companies in the US. That the ETFs that track that indice is going to give you exposure to these companies on a percentage basis, right? So SPY, VOO, and IBV. So SPY is a State Street fund that is probably the most well-known, and it is the largest traded ETF that tracks the S&P 500. VOO is a Vanguard ETF that, again, tracks the S&P 500, and IVV, which is a BlackRock company owned ETF. So those are the three most well-known major ETFs that track the S&P 500. So if you're like, hey, I really love that the S&P 500 has, over time, given me, a cool 273% over the last 20 years, and let's just give it the last, 10 years, we'll call it, a cool 100%, right? If I just wanted to just put my money in an index that just tracked that, SPY, VOO, IVV, right? Those are the three major ones, but there are obviously other ones, but those are going to track the index specifically. So when the index is riding high, those will be riding high. And when the index is riding low, those will be riding low. Moving on to the Nasdaq. So I like to think of the Nasdaq as the innovator of the three, right? It's been around. It's the youngest of the three, but I would say that it's probably the most influential of the three right now. Right? Why is that? Because they focus on innovation and diversity, two things that ultimately are going to shape our new world, right? The more you focus on innovation and diversity and taking care of your employees and making sure that things are fair, equal, and you're still not sacrificing profits. So you're not putting employees under the profits. You're not prioritizing making money and stepping over all the people that got you the money. Those are the people who are going to win. Those are the companies that are going to win. The ones that are consistently investing their time, energy, and capital into people and technology that is going to change the world, right? So the NASDAQ is the premier global marketplace for buying and trading securities, right? The NASDAQ over time, since its inception, has become kind of the proxy for the technology sector, purely because when it was first created, companies like Google, Apple, Amazon, they realized that because of how innovative the Nasdaq exchange is. So the Nasdaq exchange is the exchange that the Nasdaq Composite is on, right? So they realized early on that because of how technically sound and innovative the Nasdaq technology is, they decided it was a no-brainer for them to list on there, right? So when companies IPO or when companies decide to list on the stock market, they can pick whatever exchange they want, New York Stock Exchange, Nasdaq Composite. The majority of the time, tech is going to the Nasdaq because of just how easy the technology is enmeshed into the purpose of these companies, right? Diversity. The Nasdaq recently has proposed a rule change to the SEC that would require most boards to have at least 2 diverse directors, right? So they're requiring people that they're basically saying to companies, if you want a seat at the table, we need you to be up to par and up to times with who's sitting at your internal table, right? We can't just be having the same old, you know, uh, status quo. We just can't have the same things happening because the shareholders that are coming up, the younger generation, the new investors are not looking for these dinosaurs to just keep doing the same old things. We want to see big ideas come to the forefront and win, right? So going along with that, we need at least one person who is self-identified as female and someone who else identifies as either underrepresented or as part of the LGBTQ plus community, right? So they've covered all the bases in terms of we need at least 2 people on your board of directors that don't look like someone that's traditionally at the table, right? We need you to go out there and find that talent that is out there. Finally, how do I invest in the Nasdaq? Well, because it operates in 25 markets, you can easily find an ETF that tracks it. But the most common, I would say, is QQQ or 1Q. So the QQQ is in an Invesco. It's part of the Invesco pipeline in terms of the indices. And again, it'll go up when the whole Nasdaq is going up. It'll come down when the QQQ. It'll come down when the Nasdaq is going down, right? So we're already starting to build a bridge between ETFs and indices. The ETFs are not just, oh, I'm just going to park my money in here and whatever happens, happens. It's I can now make conscious investment decisions based on the knowledge that I know that some ETFs move in sync with indices, right? So it's not about, oh, I have a finance degree. Oh, I can read this chart. It's no, I know the information. I know that the NASDAQ is technology based. So when technology companies either go up or sell off, the NASDAQ will mimic that, right? So starting to link things together that will really help you stay calm when things are, on fire, and really start to, go after it when things are there for the taking. So let's talk about the Dow Jones. For me, the Dow Jones is the OG, right? It's the oldest. It's the smallest. It's probably like the what's it called? The boys club of the 3, right? It's very selective. There's only 30 companies in there. We really need to check you out before you come into our backyard. But on the flip side of that, I will say that they're kind of like non they're non how do I want to say this? Their biased way of looking at companies is kind of hurting them right now because all these other indices in technologies are passing them on purely based on the fact that the companies that the indices are tracking are innovative companies, right? The Dow Jones doesn't focus on that per se. I don't want to say the companies aren't innovative. They're just companies that you come to expect as they are what they are, and they are who they will be for now, right? Unless they've shown me something differently. So this is the type of index you want to really invest in, only if you're looking for kind of like that low volatility. I'm really not trying to play in the mud too much. I want my risk tolerance to be as low as possible. These are the types of companies that are going to have the great balance sheets, great fundamentals, low debt. So when things like the pandemic or an election or any type of major economic event happens, these companies don't lose money, or they're not going to lose a ton of value or a ton of equity because they are so valuable and they have such pristine balance sheets. So let's talk a little bit about other indicators of economic and market sentiment. So those previous indices, right? So the big 4 here, these are more so, all right, I'm trying to get a general sentiment of the market. Where do I need to look, right? What is the market doing? How is it moving? These are the 4 ideally the three, S&P, Nasdaq, and Dow Jones, that you want to be looking at if you want to look at a general direction of the market, right? If your favorite company is in tech, you're looking at the Nasdaq. If your favorite company is just a large blue chip, been around forever, it may be in the S&P. If your company is you really like industrials, you really like the financial markets, you're really looking for a company in the Dow Jones, right? So regardless of what your interest is, there's an indice for how you can invest in that interest, right? If we want to think a little bit deeper, right, then, oh, I like this company, let me find an index for it. If we want to start thinking about how we can build wealth, right, and start to create strategies that will buy us back our time, right, then we have to start thinking about other ways that we can look at the market and the general economy and see how we can, find those opportunities to make money, right? Because at the end of the day, buyers, sellers, bears, bulls, it doesn't matter. It doesn't matter, right? You just don't want to be a pig. You just don't want to get slaughtered. Everybody's making money, hand over fist. Just don't let you be the one they're making money off of, right? So here's some other ways you can think deeper about the market and really get a sense of what your stocks, your trades are going to do in the future, right? So the Russell 2000 index, the CBOE volatility index, the 10-year Treasury note, and then the fear and greed index. 4 of my top ways to really look at the economy and the market sentiment to really get a true picture of what is going on, other than what the pundits are saying and the analysts are saying, because they all have their own agendas. We have to find our own. We have to figure out what works best for us. So starting with the Russell 2000. Why does the Russell 2000 matter, right? The Russell 2000 is an offshoot of the Russell 3000, which is the 3,000 largest companies that have the majority of their operations in U.S. markets, right? The Russell 2000, right, and that Russell 3000 is broken up into the 2000 and the 1000. So the 1000 is the top 1000 companies in the U.S., and then the Russell 2000 is the bottom 2/3 of that 3000, right? The reason why people really look to the Russell 2000 is because it gives you a better picture of the entire market, right? The S&P 500, the Dow Jones, the Nasdaq, they are great, but they give you a very narrow view of the market, right? They're only giving you a piece of the pie, where the Russell 2000 gives you 2,000 companies to look at rather than 500. The Nasdaq, depending on which composite you're looking at, between 100 and 500 companies, and then the Dow Jones is just 30 companies. It's like the Russell 2000 gives you a better mix, right? It also focuses on smaller cap companies that are really just trying to get a gauge of those smaller companies that are actually moving the economy, not those one-off companies like the Apples that make a crap ton of money, but the rest of the people in their industry or sectors are not moving that way, right? So we can't get a large economy picture by just looking at an Apple or a Microsoft or a Google or an Amazon, because that's going to tell us a much different picture than looking at, an Intel, a Qualcomm, an Apple, a Microsoft, an AMD, a Caterpillar, like mixing in companies with smaller market caps that will ultimately give you a better picture of what the greater economy market is doing. The Russell 2000 is definitely something that is ideal for a newer investor to invest in, because again, it gives you that broad range of companies to choose from. The Russell 2000, it's great for if you want to just go look at the Russell 2000 and go down the list of the companies that are in there. That's a great way to start to get an idea of where your interest lies, right? The most commonly traded Russell 2000 ETF is IWM, and that is, I believe, I don't want to give you wrong information on that. I forgot what company that IWM is through, but I believe that's also an Invesco ETF as well. But that's probably the most heavily traded of the Russell 2000s. Let's talk about the VIX. All right, so the VIX index is something that you probably want to put on your watch list right now. This is something that even if you don't truly understand what is happening with it, it is something that will ultimately tell you what the market direction is looking like, right? So on this very basic level, the VIX measures volatility, which is a mixture of the risk, fear, and stress in the market on any given day. On any given day, but the VIX tracks on the last 30 days, right? So the future 30 days of the expiring contracts, right? So don't worry too much about that. That's a totally different education. But the VIX is based off the future 30 days of expiring contracts within the major indices, right? Why the VIX matters is because it'll tell you what the market is going to do, right? So if we were to overlay this chart here, right? You see how it's going up and down, up and down, up and down, real jagged and weird like, right? If we were to overlay the S&P 500 chart here, right, it would mimic this, but mirror it, right? So instead of this going this way, going up, right, the S&P 500 one would be going down, right? So when you want to think about it, it's when the VIX goes up, when the VIX number starts to go up, stocks will start to go down because the fear, the fear, the risk, all of that is in play, and people are starting to get antsy based off of the volatility of the next 30 days, right? They're anticipating something that is not good, that is causing them to sell, and as that number creeps higher, stocks will go lower because of that selling pressure, right? Vice versa, when the VIX starts to come down, right, stocks will start to come up because that risk, fear, stress is no longer in the market. So that number is telling you whether that stress and fear is dissipating or filling up again, right? Some numbers to really think about. We really want to pay attention to the VIX when it starts to hit that 15, 16 range. That's a great opportunity for you to see that there's no fear in the market. It's probably a bull market. It's probably, stocks are going up. They're hitting their 52-week highs with regularity. Some pullbacks, not too much, that kind of thing. When you start to see the VIX rise above the 35, the 45, the 50, that's when you're going to start to see those major pullbacks and those sell-offs, right? The VIX today, as you can see up in this upper left-hand corner, finished today around 22. So, that's not too bad. There was a little bit of sell-off in the market today, but stocks are still at or near their 52-week highs. All the major indices, the Nasdaq especially, is up near its 52-week high. SPY is up near its 52-week high. So that 22 tells you, yeah, there's a little fear, but it's nothing, right? When we start to creep up to that 35, 45, 55 range, that's when, as long-term investors, we start to rub our hands together a little bit because we know that there's a lot of fear. And because the market is based on two emotions, fear, greed, right? We have the expectation that when the VIX goes up, stocks are going to go down, and that's going to present an opportunity for us to buy more and get great stocks at a discounted price. And just some opportunities to see where that came in is just look over here on the left, 2000, the dot-com bubble, right? That dot-com bubble we heard so much about, right? The drawdown on it wasn't too bad. We only saw about the VIX went up to just under 40, a little over 40 during the height of the dot-com bubble, right? Look at 09, economic crisis of 09. The VIX is off the chart. We know how bad 09, 08, 09 was, right? And look here again, crash of 2020. VIX got up to just below the 70 mark. So these are things that we can see on a macro level that we don't need to be a genius. We don't need to hire anybody. We don't need to give anybody of our money to tell us that, hey, when the VIX starts to get up to that 50, 60 range, depending on what your strategy is, you may want to sell, right? If your strategy is to, buy low, sell high, fine. But if your strategy is keep getting equity in these great companies at great prices, then you really want to watch the VIX to see when your opportunities may arise. let's talk Treasury bonds, okay? So when we're talking Treasury bonds, we're talking specifically about the 10-year bond right now, right? So this is going to be the 10-year Treasury yield, specifically because it's just a better benchmark. It's just easier to understand, right? So just keep that in mind for the context. So basically, on how they work is as yields rise, the interest rates on consumer and business loans will rise as well, right? Because it's all based on supply and demand. So when the demand rises, obviously the Fed and the U.S. government, because they're guaranteeing the initial bond plus the interest, they're going to guarantee it, but they don't want to pay, too much interest on it because obviously that would be non-beneficial for them, right? So what happens is when they put these bonds out at auction, they're sold initially 10 years, whatever, 3% interest. Like we'll pay you back in 10 years with 3% interest in full. When that bond is then sold on the secondary market, right? There's no standard rate in which that yield has to be traded for, right? The only guarantee is on the actual amount of the bond, right? The yield no longer becomes guaranteed because it's then being traded on the secondary market, and it's now being subject to those yields that are being raised and falling, right? So the initial Treasury bond comes out at a set rate, and then once it moves into the secondary market, it's now subject to those interest rates fluctuations, right? So that's on the basic level. You buy the initial bond. If you keep it, that initial rate that was set on it is yours until you cash it in, right? Once you exchange it on the secondary market, that bond now becomes subject to the different yields, right? So how do bonds affect you, and how can you use them to gauge what the economy is doing? Well, when the yields rise, the banks charge more interest on mortgage payments, right? So for the 10-year yield, you're looking at the 15-year fixed mortgage rate. When you're looking at the 30-year bond, you're looking at the 30-year mortgage rate. So when you raise the interest rate on the Treasury, the loans and the debt that is the same length usually goes up with it. So in this case, when banks raise the interest yields, you pay for it as the customer because you now have to buy a smaller house for more money, right? That's why it's better to be buying when the interest rates are low, right? Because that way you can get more bang for your buck. Another ticker that you want to add to your watch list is definitely the TBT Pro Shares. That is the Treasury bond. That's the Treasury bond trading ticker, where you can buy shares of it, you can trade options on it, but ultimately I just use it as an indicator, right? If I see that bond yields are going up, I know that stocks are going to go down, right? Because traders are trying to, and institutional investors are trying to capitalize on those high yields, right? So, and vice versa, when the yields are low, we're all up in stocks because money's cheap, right? These companies are not exempt from those greater macro level movements. So interest rates that are high work less in favor for a company than interest rates that are low, right? So that's why when the stock market, when Yellen comes out and is like, hey, we're gonna have to raise interest rates, stock market doesn't want to hear that, right? Because then it's gonna become more expensive to own these companies, right? And we're gonna run to the bonds because those yields are gonna rise, right? So again, those are things that we got to think a little bit deeper as investors, because when the market is going red, when we're drawing down 10, 20, 30%, we got to understand that there are macro level economics at play, right? It could be inflation, it can be interest rates, it can be anything, right? So we have to be sound in our knowledge and our research. Lastly, I want to talk about the fear and greed index. So we talk a lot about fear and greed and volatility, right? So the VIX measures volatility through a lot of statistical algorithms and math, right? The fear and greed index does the same thing, but it's a greater visual of how the emotions are reacting with each other right now, right? So the VIX is more of an indicator of 30 days out. Fear and greed is literally today as of right now. So today it ended at 51 neutral, which is kind of funny because uh, that just tells you how much indecision is in the market right now. People have no idea, regardless of who's telling you what. No, people have no idea what these stocks are going to do, what these companies are going to. What we do know is that these companies are going to continue to print money, right? Great companies are going to continue to be great. The Fed is going to continue to try and keep interest rates low, right? But that's going to keep inflation high, right? We know that Bitcoin, cryptocurrency, the decentralized space is here. We know those things, but we also don't know when COVID's going to go away. People are going to go back to work for good. You know, is our school systems are they permanently damaged? You know, are online educators now going to come to the forefront? Is the chip shortage going to be something that really keeps having a ripple effect on, you know, not just the semiconductor industry, but also on cars? You know, there are a lot of companies that are trying to catch up to a Tesla right now, right? GM, a Ford. Uh, those are the companies that are using chips in their cars from like an AMD, who is currently going through a chip shortage. So a whole lot of things are happening right now that we have no idea are going to turn out. So this 51 right here is as accurate as it can be because there's just so much indecision. So pay attention to the fear and greed index. Just type it in on Google. This is on CNN. CNN is the one who has it. But if you're wondering where the numbers are coming, how they get these numbers, they use stock price momentum, strength, the breadth, put and call options, junk bond demand, market volatility, and safe haven demand. So that safe haven demand is basically the ratio between people running to the bonds and people, you know, in the stock still. So here are my recommendations for any type of investing, or if you're going to go out and look at the indices and pick out companies that you think are going to help you build wealth, but ultimately keep it, right? Educate yourself first and then take action. If you go and look at the Russell 2000 and you see 18 companies that you like, don't just go buy 18 companies, right? Educate yourself first on these companies, right? Just because you know how they make money and how they make their products does not mean you believe in their vision, right? You have to believe in their vision. You have to know how they make money. You have to know how their leadership works. There's a lot to it, right? Educate yourself first so you don't learn those expensive lessons. I'm not a day trader. I am not someone who trades. I don't sit at the computer clicking buttons. I am a long-term investor. I see wealth building as a journey, right? Educate yourself first, but you have to take action, right? Don't just read a bunch of books and then get stage fright. You do have to go on the journey, even though it is a long one, right? Understand your risk tolerance. There's no one who's going to care more about your money than you, especially especially in these times, right? This last year has seen a lot of retail investors jump into the market with no idea of how to actually fish, right? The stock market should not feel like gambling. If you are gambling, you are doing it wrong because at the end of the day, your risk to reward ratio should be low risk for high reward, right? We're not trying to, you know, we're not trying to invest our, you know, last $100 that we could be using for groceries into the stock market just because we heard, you know, Dogecoin going to the moon. No, that's just not how we're going to do it because you're setting yourself up to fail with bad habits. Understanding your risk tolerance comes with educating yourself on risk, reward, and the asset class that is going to fit your risk tolerance. Okay, Bitcoin may not be for everybody. Stocks may not be for everybody. Real estate may not be for everybody. But find what is for you understand that it is for you, and then make that move. Pick a strategy and stick to it. FOMO is not a strategy. I get DMs all the time. Man, what do you think about this stock? I wish I got into it earlier. Or I just did this. I hope it does this. FOMO and hope are not strategies. Do your research, understand the plays that you're making, because again, nobody cares more about your money than you do, you know? And then start today. Every investment you make is you buying back your time. The more time you have, the more time you can do spending it with the ones you love, doing the things you love to do, and ultimately giving back, right? We do all this because we want to have more time to give back to those who can't do it for themselves, right? That being said, any questions? I know we got some questions now.
I have a question.
Sweet.
For the first time investors, like like beginners, ones who just joining in, what would you suggest? Like, is there? Because I personally use Robinhood, and I feel like that's been giving me not only great results, but it kind of breaks everything down just a little bit. Um, Not as much as you did just now, but as much as they could for an app. But what would you suggest, that or something else, or just doing it like personal?
So in terms of Robinhood, I have no thoughts on Robinhood. I don't truly believe in the platform, only because I look at investing from a long term standpoint, and they really do push like the. I mean, I guess they don't push options, but they don't do a great job of helping people mitigate their own risks. So I would always say, if you're starting out investing, use a more reputable um, source, especially one that has a customer service, right? If your money disappeared from Robinhood today, you couldn't call Robinhood, right? There's no one on the other line to be like, "Hey, where's my money?" You know, other brokerages like a Fidelity, a TD Ameritrade, a Schwab, a Vanguard, a Webull, a trading station, a bunch of other companies besides Robinhood that, worst comes to worst, you can at least talk to a live person.
Right.
And then in terms of like doing, are you talking about like investing by yourself? Or,
Oh no, that you hit the nail right on the head
all right,
just now.
cool, perfect. What else? And it's open now, so any question is definitely welcome. Um, Especially for those who are watching this later on. Any questions that we can answer right now would be helpful. I got a question for you guys. In terms of the next 5 years, who I want to hear from each one of you guys. Give me one sector, industry, technology, whatever, that you see winning over the next 5 years. And you can just throw it up in the chat, or you can speak up.
Um, well, I personally I've been investing in technology like Palantir Technologies. I've been with them for about a year, so it's been a bit of a rough ride, but they've had their ups and downs.
For sure.
But yeah, I can definitely see them long term doing great.
Yeah, they're. I really like Palantir because of the data piece. I think data is going to be the new currency going forward.
Hmm.
The more data you have, the more data you can digest, the more data you can access and analyze, and then also put into actionable uh, steps, I think those are the companies that are going to win easily. And I think Palantir is, especially since they have, government contracts, which, the government's not going anywhere.
Right.
Also, they're expanding into their commercial space, which I think I don't know if you saw, but they're going to start offering their technology, their I think it's Foundry, whatever it's called. They're going to start offering that for free to companies to start getting them, like intricated into their system, and make it easy for them to acquire customers. So I think Palantir is going to be a winner for sure. And that's not financial advice. That's just, it's a solid company.
Yeah, I did my research right before I got it at like $8,
Nice.
and then it's just been
Nice.
trying to hold steady.
Awesome. Beverly?
Yes.
You there? What company or industry or sector do you see winning over the next 5 years?
I'm new to this, so that's why I'm taking your.
Oh, really?
Yeah.
Well, welcome. But I mean, you're a smart woman. What do you think would be something that would be okay? Let's just keep it simple.
Uh-huh.
What company do you think is going to be around 10 years from now? Like
Apple.
yeah. Besides Apple,
Okay.
that you use or that
Oh,
you're
I don't
familiar
use
with.
Apple, so let me see. Well, yeah, I do. I use the iPad. What company?
Or sector, industry, anything.
Oh, education and healthcare.
Education and healthcare. Okay.
That will always be around.
What about education? What specifically? Just how it's gonna change, or
Well, with universities and college, I mean, I know you don't get money out of it, but when you look at the long term, every time there is a shift in dynamics in like people losing their jobs, it always falls back to education. People are always reinventing themselves. So if somebody loses a job and they want to better themselves, they go for something new. People switch careers, they go back to education to move forward. So, and in education, I would say the department I work in is always going to be there, computer science and engineering, computer science. It's going to be always there.
Absolutely. And I totally agree with you. That was education was one of my biggest disruptors. I think the education space is due for someone to come in and just revamp the whole thing, because these large institutions, universities, they're essentially businesses. They're not really in the education space anymore. They're in the business of collecting, payments and then giving you a piece of paper at the end, which, not knocking education, not knocking, higher institutional learning. Obviously, I've done it. But when it comes to the efficacy of learning, is a higher institution something I'm going to want to pay for, as a Zoomer who's like 18, 19 years old, who's seeing the debt crisis, who's seeing people can't get jobs, that kind of thing. I think the education space is due for disruption, and I actually have two tickers for you, Auntie, if you want to look into them. The two companies. The first company is called 2U.
2U, okay.
Ticker symbols TWOU, I believe.
WOU,
And then Coursera. Gotta look up their ticker real quick. Coursera.
Did you say Coursera?
Yeah, Coursera. COUR.
Oh, I take a couple courses on there.
Yeah. Yep.
So and don't get me, when I say I'm new to this, I'm with myself doing it on my own. Of course, I have money, a financial plan, but I want to understand what they're doing with my money.
Exactly.
So,
Because at the end of the day, no one no one is gonna care about it more than you will, right? So yeah, to you, Coursera, and then you said healthcare was
yeah,
the
well, again, healthcare is always going to be around. Case in point, this past year.
right. So healthcare is a great defensive sector. So when things start to like hit the fan, in terms of the economy and inflation and people losing jobs, all that kind of stuff, people to hold on, y'all. Can we mute this real quick? Hold on. I'm just gonna mute you guys so we don't feedback. Um, so when we're talking about like preserving our money in a downturn, healthcare is definitely a defensive stock. Financials, like the banks, those big pharmaceutical companies, like those companies aren't going anywhere. They've been printing money for years.
Mhm.
I'll give you two of my favorite healthcare stocks
Okay.
that pay dividends as well, but they can also be classified. I could classify them as growth dividend stocks.
Uh-huh.
And again, this is not financial advice. This is just do your own research on them. But AbbVie,
Mhm.
so ABBV,
A what?
um, AbbVie. So it's ABBVIE is the name of the company,
Uh-huh.
and then the ticker is ABBV.
ABBE. A is in apple, B is in boy, B is in boy, E is in Edward.
V as in Victor.
Oh, V as in Victor.
Yeah. And then
AVVE.
ABBV.
Oh, okay. ABBV.
Yes.
Okay.
Yes. And then CVS.
Mhm.
Can't sleep on CVS because people fail to realize that yes, they have the convenience aspect of it, right? So like that discretionary money, but they're the third largest health network in the country. They acquired Aetna 4 years ago. So behind like United Healthcare and I believe Cigna, yeah, or something like that. Um, Mom might actually be able to help on that one. But so AbbVie, CVS, and then I'm gonna give you XLV, which is the healthcare sector ETF. So that's an ETF you can look at, and the top 10 holdings are all great companies.
Okay.
And I believe
So what's the ticker for those two?
so CVS is literally CVS,
Okay.
and AbbVie is ABBV, and then XLV is the ETF.
Okay.
So yeah.
All righty.
Any other questions or comments, or if anybody has a stock specific question, indicators, investment, just long term?
Nope, I'm all set.
Ooh,
I totally agree with the healthcare, especially big pharma.
big pharma for sure.
Yeah,
Hmm.
I see $1 million drugs come across my desk all the time. So it is the way to go. And CVS, Aetna, and any pharmacy benefit managers that are out there like Optum.
Ooh, you trying to drop some tickers, Mom?
Hey. But yeah, CVS and Aetna, with their acquisition of Aetna, has become one of the largest healthcare providers out there. And like you said, you can't sleep at the convenience and the walk-in. They perform many clinics, and now with a health plan. And I think they also has Express Scripts, which is, I believe, they're what we call PBM, pharmacy benefit managers. So yes, big pharma, and of course we know with the COVID vaccine,
Right.
Pfizer and Moderna are making their mark. in regards to as names out there.
In terms of the, so also CVS, they pay a dividend of 50 cents quarterly. But Mom, in terms of those drugs that come across your desk, are you seeing more consistency in like a concentration of companies, or is it a bunch of different companies?
It depends on who. It's specialty drugs.
Gotcha.
So, and this is why I talk about Optum, because they manage that benefit. And I think Magellan is another company to take a look at, because they manages the specialty drugs and approve the benefits for those.
Right. What's
So
the
there's drugs out there for spina bifida for a child who was born with the genetics, of spina bifida. Within the first 6 months, if they take $1 million, there's certain drugs. There's a strong possibility that it lessens the effects of the spina bifida.
Right.
There's also drugs out there for, you see it on commercials all the time, whoever the company for Humira. Humira,
Yeah.
anything for Crohn's disease, drugs with biosimilars. I mean, it is amazing what is out there for these drug companies that are making these products. It costs health plans a lot of money.
Right.
So yeah.
Can you spell that Optum? Is it Optum?
Yeah, OPTUM.
And it doesn't look like they're public.
They're not public?
No.
No. Okay. So you're basically looking at companies that are public. That's right.
Well, so there's an interesting point that some ETFs do have shares in private companies. So I may be able to find this company in an ETF somewhere, even though they're not public. And that's the beauty of ETFs, is because they have access to companies that have private shares within the ETF. So I'm gonna look into that one for sure.
Yeah.
Vivian, do you see there's a guest on tonight?
Yes, I happen to see her name. I'm so excited. I'm like, is that really who I think it is? Yes. So, hi, Pam. Sorry, Antonio, I don't mean to like.
Hey, it's all good. The community forum. I'm glad. Pam, welcome. Appreciate you being here. Yeah, tell your friends to tell a friend. We're doing different topics every week. Next week we might go back to a specific stock breakdown. So if you guys have any specifics that you want me to break down for you, let me know. But yeah, this is like save the time. 8 p.m. Wednesdays, we're gonna be hopping on here discussing.
And Antonio, when you do that, put 8 p.m. and 7 Central.
Hey, you're the only one who needs to do that. I know what close I live
because
on.
when I forward it to friends, they're thinking it's 8 p.m. my time, and I keep forgetting to put 7 Central on there.
I got you. I'll do that just for you.
Listen, you want me to spread the word? I'm in the Central time zone, right?
I love it. Appreciate it.
Well, thank you. This has been very educational, and for us at those of us at a certain age who only believe in 401 or Ks or 403, it's kind of risky for us at again at certain age to start investing. But if we make certain take certain risk, the reward could pay off. But
it's all about knowing your own risk level and going from there. Like you don't need to take off more risk than you want. So we'll get there. We'll get there.
For sure.
I just have a quick question before we leave. So I'm sure you heard of Tilray merging with the other cannabis company up in Canada.
Yeah, Afria.
Would now be the ideal time to invest in that, or would would it just be just an investment that's just gonna just be stagnant?
Right. So I'm just gonna give you my thoughts on it. I'm not gonna give you like a specific like investment advice on it because that's not what I do. But I will say that when companies merge, right, usually the acquiring company will
Hmm.
go down, right, and the company that's being acquired, their shares will jump, right. So probably the best time to have invested in Tilray at this point would have been when off the news of them acquiring, right?
Yeah.
Since then, Tilray has kind of consolidated a little bit, and Afria has gone up, right?
Hmm.
So at this point, how I tend to look at it is you can really dive into the math and really decide on what deal is better. But based off what I know, you're better off getting more shares of the company that's being acquired because it'll end up being cheaper. Like the conversion ends up being a little cheaper,
Hmm.
depending on like when the run up happened. So at this point, the announcement happened like 4 or 5 months ago. So
Yeah.
there really is no more news that's going to like change anything. But you'll start to see towards the closing date the run up on the acquired company, right? Because
Right.
people want to get more shares of that company because it's gonna transform into a Tilray. So that's kind of how you want to play anytime a merger and acquisition happens. Is look for the company that's acquiring because they are spending a crap ton of money to lose some stock price, and for the other company to have a slight jump. And then as they get closer to the date, right, the acquired company is going to start going up again, right, and the
Mm.
acquiring company stays a little stagnant because people already know the money is being spent.
Right.
Right. So at this point, I would, looking at the, let me look at the tickers real quick. Um, because also with that space in general, we just don't know who the winners are going to be. But we like seeing mergers and acquisitions because that means companies are not sitting on their laurels. So Tilray right now is at 15, right? It's about its all-time high is at 60. Oh, its 52-week high is at 67, right? And then Afria, what's the ticker on Afria? I don't know at the top of my head. See, so you know the ticker on Afria?
Give me just a moment.
I wonder if it already happened.
Um,
I thought it happens in June, but anyway, um, Tilray's at 15. Afria can't be more than that. Probably a little less. At this
mhm.
point, if you can buy both, I would buy both because it's going to be the same company. Uh, Usually, when they're moving in tandem like that, when one has a down day, buy that one. When the other one has a down day, buy the other one. But this is one of those ones where it doesn't really matter right now. You got to pay attention to when they first announce what the move
Mhm.
is.
All right.
Cool.
Cool.
Anything else? All right. Well, thanks you again. I really appreciate you guys sticking with this. This was week 5, week 6. Next Wednesday, 8 p.m., 7 p.m. Central Time. All right. But this is going to be the same link each and every time. So tap in next week. I'll be dropping the topic in the next few days. But until then, I appreciate y'all. Be safe, be happy, be healthy. See you at the next episode.
You're gonna drop this in the family chat?
Yeah, I'll once the recording's saved and everything, I'm gonna put it on YouTube.
Okay,
All right.
all right,
Take it easy.
DM me
Thank
if you
you.
want the PDF too.
all right.
All right. Later.
All right.
Um,